Welcome back. We are now busy with Unit 8, Fund Administration and Record Keeping. It's still part of Class 4, Retirement Fund Benefits, in our Class of Business series. The next session, we'll look at Fund Administration and Record Keeping and the trustees' responsibility in this regard. Trustees are responsible for administering their funds, even though the practical day-to-day functions will generally be delegated, perhaps to a professional administrator. However, even if a separately registered administrator carries out such functions, it remains the ultimate responsibility of trustees to ensure that the day-to-day care of the fund is carried out properly and effectively, and that the benefits are administered following the fund rules. Trustees meet their fiduciary duty of monitoring the fund's different administrative facets by using service level agreements. Now, what is a service level agreement? A service level agreement, or a SLA, the terms of service level agreements with third-party services providers should be reviewed regularly by the trustees to ensure that the roles and responsibilities of each party are clear and penalties for non-performance are appropriate. A service level agreement should detail minimum controls and reports in areas such as accounting, banking, investment management, and custodial services. Trustees should implement, monitor, and receive reports on procedures to enable performances to be measured against the level set in the service level agreement. Although written agreements between trustees and a third-party administrative service provider are not compulsory, they are recommended as best practice. The service level agreement should contain at least the following provisions. 1. The start date and terms of the agreement. 2. What duties, powers, and functions of the trustees are to be delegated to the administrator. Measurable standards of care, skill, and diligence should be applied to each of the functions carried out by the administrator. The timelines under which administrator must carry out each of the functions. The frequency of compliance reports being given by the administrator to the trustees. The liability of both parties for any loss that incurred. Resolutions, for disputes. Provisions dealing with the confidentiality of information and protection of member database should be included in the service level agreement. Right, the types of fund administration. If we look at insured funds, insurance companies administrate these funds and have all services and benefits provided by the insurance company. Services like administration, investment management, consulting, auditing, and valuations are all offered in-house by the insurance company. The Board of Trustees deal with the insurer on all matters relating to the fund administration, management, and investment performance. Even though the running of the fund has been delegated to the insurer, the Board of Trustees remains ultimately responsible and accountable for the administration, investment strategy, investment portfolios that the fund invests in. The investments are usually in the form of insurance policies and assets held in the insurer's name. So this is now insured funds. When we look at self-administrated funds, unlike insured funds, self-administrated funds are set by the employers, the industry bodies, or the unions, who then employ professionals to administer the fund on behalf of the members. The Board of Trustees would then need to appoint a service provider for the investments, the actuarial services, the audit, and for the insurance. These funds are also known as privately administrative funds. Payment of contributions due to a retirement fund. In Section 13 of the Act provides the parameters that must be followed when contributions are being made to the fund. The employer in Section 13A(2)(a) compels the employer to complete a monthly reconciliation of contribution payments prepared and submitted to the fund, together with payments within 7 days after the end of the month for which they are due. Regulation 33 of the Act, the employer must provide the following information. A period that the contributions are payable. B, the name and address of employer or pay point where the deductions was made and the responsible person to contact. C, details of members' full names, date of birth, identification number, employee number, date of membership, pensionable salary and amount of contributions split between member and employer, and any voluntary contributions deducted. Subsequent returns in respect of each contribution period must reflect the same information as the period before a conciliation, setting out any differences in the data, such as new members, membership terminations, salary increases, etc. Should 90 consecutive days pass without contributions be made by the employer to the fund, then Regulation 33(5) of the Pension Funds Act authorizes the principal officer or any authorized person to report the matter to the National Prosecuting Authority, the NPA, with a further 14 days after the end of the 90 days, and then to advise the FSCA of such non-payment. The fund administrator is responsible for checking the receipt of electronic transfers into the fund's bank account and the reporting of non-payments to the principal officer and the trustees. The principal officer is then required to bring any infringements to the notice of this to the members of the fund. Compound interest on late payments will be calculated and charged to the employer. Section 13(7) of the regulation and 33(7) deal with the charging of late payment interest, LPI. If contributions are not paid within 7 days, or if the contributions are not confirmed, then LPI is charged from the first of that month up to the date that the amount was paid or confirmed. Right, record keeping. The Act specifies that the trustees shall ensure that proper membership and financial records of the fund are kept. Trustees should ensure that the employer provides membership data to the fund administrator timely. Trustees frequently delegate the fund administration, including a collection of contributions, to the third parties, the employer and their professional investment managers. The core administration functions that a registered administrator must carry out are: A, the preparation of annual reports. B, the preparation of annual benefit statements. C, the maintenance of sufficient records to provide such services. And D, the payment of these benefits. Trustees should always keep in mind that overall responsibility of stewardship of the fund's assets, transactions, and record keeping rests with them. Trustees must ensure that there are proper procedures and monitoring controls in place to enable accurate and complete membership and financial records to be kept by them and on their behalf. As far as membership records are concerned, 1, current membership. Typical membership records will include the member's name, gender, date of birth, date of joining service, and the date of joining the fund, their marital status, details of dependents and other beneficiaries, current and historic annual salary details, transfer values received and benefits granted by member contributions, and any additional voluntary contributions. The precise nature and amount of the information which must be kept will depend upon the nature of the fund and the type of benefits that's provided by the fund. The second group of membership records is pensioners and deferred pensioners. In addition to keeping records relating to the current membership of the fund, it is also necessary to keep records of pensioners being paid from the fund where applicable. Then your financial statements. The financial records of the fund are frequently kept on behalf of the trustees by a fund administrator, who may also prepare the accounts for audit. The audited financial statements must be submitted to the registrar within 6 months after the end of the financial year of a retirement fund. A failure to comply with the 6-month provision is an offence and attracts penalties. Every retirement fund must appoint an auditor who must be approved by the registrar. The role of the auditor is to ensure that every financial statement of the retirement fund is properly drawn up and fairly reflects the financial position of the retirement fund. It is the role of the auditor to bring to notice of the registrar at any time any irregularity in the financial affairs of the fund. The financial statements are one way in which trustees can monitor the overall running of the fund. The financial statement contain critical information that trustees should take note of. The following are pointers that trustees should take note of. The fund account. It shows the amounts of money going in and out of your fund during the year. For example, contributions received, pension paid out, and investment income. This account provides detail of the fund's financial dealings with members, the employers, and other directly involved in the fund, and shows how the trustees have looked after the investments in their care. Fund assets and liabilities. The assets include the market value of the fund's investments. Any amounts owed by the funds are shown as liabilities. Notes to the account. The notes give important additional details, particularly the type of investments owned by the fund and where these are invested. This is to client trustees to the possible risks, to alert trustees to the possible risks associated with concentration of investment, or perhaps having too many eggs in one basket, or even investments in the employer's business or an associated business. Right, auditors' comments and opinions. The auditors will state whether, in their opinion, the fund is being administered following the rules and is best interest of the members. Trustees need to take note and take action on the issues raised in the financial statements. Right, membership communication. Trustee disclosure requirements as far as communication. In PF 86 deals with disclosures to members during their period of active membership of the fund, whilst PF 90 deals with disclosure requirements to members at retirement, deferred pensions, and dependents in the receipt of benefits as a result of the death of a member before retirement. PF 90 set out the minimum standards to be adopted, but the disclosure format is not prescribed. It is, however, imperative that disclosures is in writing and is clear and unambiguous, and in the plain, simple language, and in any one or more of the official languages of South Africa, having regard to the composition of the members and the needs of the members of the fund. Pension funds must arrange periodic meetings with members, pensioners, and dependents where they can learn about the fund's benefits and the fund's running, express concerns, and ask questions and interact with the trustees. Right, further member communication. Minimum information is expected to be disclosed to the following groups of people. 1, disclosure to persons eligible to become members. 2, disclosures to new members. 3, annual disclosure to active members. 4, annual benefit statements. 5, disclosures to terminating members. 6, disclosures for retiring members. And then 7, disclosures to beneficiaries on the death of a member. The board therefore has a duty and responsibility to formulate appropriate communication strategies suitable for the fund membership profile by applying different strategies like online benefit statements, periodic face-to-face workshops, annual fund general meetings, regular newsletters and booklets, and or any other form of communication method that allows interaction with their members. The table below summarizes main areas in terms of communication that the fund needs to address. Number 1, the rights of the members. Any member may request that the fund provide him or her with a copy of the rules of the fund, the latest financial statements, and the valuation report. New members, explanatory pamphlet within 3 months of the date of admission to the fund, and then benefit statements, which is an annual statement that must be given to every member within 6 months after the fund's financial year end. Details of the fund, which is the fund's name and its registered address, the name and the job title of the person who can be contacted to answer queries, together with the person's relevant contact details, the fund's reference number as it is at the FSCA, then also details of the benefits, the date of the calculation of the benefits that become payable at relevant instances, for example, the value of any benefits payable at death, disability, or ill health, withdrawal and or retirement benefits, the rate of contributions, the current contribution payable by members and the employer, admission or administration and the risk benefit costs, any additional voluntary benefits, any transfer from pension funds must be identified separately. Dispute resolutions, the procedure for internal dispute resolution and access to pension fund adjudicator if that's necessary. Beneficiary nominations, a note stressing the importance of nominating a beneficiary and keeping any nominations up to date. Benefit counseling, emphasize the importance of obtaining professional advice when benefits become due. Benefit taxation, how the benefits will be taxed. Notification of members of specific events like fund restructuring, reduction or increase of benefit or contributions, if there's any rule amendments, transfer of benefits to another fund, then withdrawal from service, explanation of the different options available to members, the tax implication and the impact on the retirement funding in the future, with an emphasis on the facts that no income tax liability is incurred if the proceeds are transferred to another retirement fund, if they should leave this fund. What happens at retirement, an explanation of the available options and the tax implication for each option they take at retirement. What happens at death, the impact of not attending medical requests for those with benefits above the free cover limit, the importance of nomination forms to be in place at death, and the role of trustees to distribute benefits in terms of Section 37C. And then a newsletter or members' newsletter that can be provided, where the provisions of the fund information on fund investment performance, changes in rules, benefits, and legislation, either quarterly, half-yearly, or annually, as determined by the trustees, can be communicated. And this can all be done also in a membership booklet, which sets out the following: eligibility, who is entitled to join the scheme and when, what is the normal retirement date, the age members has the right to retire, the definition of pensionable salary, benefits payable and the basics with examples, members and employer contributions, conditions on the temporal absence, member trustee election process, rule amendments and procedures for changes to benefits, taxation of benefits, claims processing and how that will be dealt with, taxation of contributions, and then lastly the opinions available on the different exit modes. This then concludes our session on fund administration and record keeping. We will then continue in our next session, which will be Unit 9, where we will discuss fund governance. Thank you for listening to this session. Then I'll see you in the next session, session of Unit 9, which is fund governance.